Hi folks, David Waring and Mark Prosser here again from LearnBonds.com and our weekly $200 billion worth of bond advice show. So this week we've got another video from Bill Gross talking about gold and a few other things, so I thought we'd jump right in with that.
Could you give us a little bit of a prediction for 2013? Where do you think gold's going to be?
Well, let me put it this way. You know, it's hard to know in the intermediate term. It's hard to know whether the current price is the right price, but gold has been influenced over the past 3 years significantly by the amount of lowering of real interest rates, to the extent that real interest rates on 5- and 10-year treasuries are in significantly negative territory. That means that gold, you know, basically is an asset that it is favored relative to those negatively yielding instruments. And so, you know, if we continue to see this environment going forward, then gold, which is the alternative to printing money, basically, which the Fed has been doing, the ECB's been doing, the Bank of England has been doing, you know, it's simply a hard money, a hard currency alternative to what's been going on over the past few years. So in terms of the price, I leave that to you on the short term and maybe even the intermediate term. But for those investors that are looking to protect themselves against inflation and against inflation printing, then gold and real assets are a significant, you know, alternative hedge.
Okay, so not really a directly bond, comment. It's really more about gold. But what I thought was interesting about this is how other markets and determining price action in other markets, you can often do that by looking to the bond market.
Well, David, I want to make 2 points. One is he had an interesting use of words. He said protecting against inflation and protecting against inflation printing. And I think inflation printing is really, you know, loose monetary policy, right? You know, the Fed buying up all these treasuries and just putting a ton of money into the market. What's interesting is that's about, you know, there's more money, there's a fixed amount of assets, there's a fixed number of houses out there, a fixed amount of gold. Well, you know, that tends to push up those fixed assets. So I think I think the fact that he used those two different words, I think meant that, you can have appreciation in asset prices, without necessarily having an increase in inflation or consumer inflation.
Gotcha. So another thing I found was interesting about that, and there's a lot of people talking about there's a bubble in gold just like there's a bubble in bonds, and the thing that I found interesting about it for potentially people interested in gold is that negative real interest rates make gold a lot more attractive than would be the case otherwise, since gold doesn't actually earn any interest.
I couldn't agree with you more. There's some cost of carry, right? You know, if you buy a bunch of gold coins and put it, dig a hole and put it in there, you're not going to earn any interest on it. You put your money in the bank now, you're not going to earn any interest in it.
Right.
So really, the cost of owning gold, the cost of carrying it, whether it's through a futures contract or through actually buying it, is actually low because you're not going to be earning more money elsewhere.
Right, the opportunity cost.
The opportunity cost, that's exactly the words I was looking for.
All right, very good. So now let's go on to Twitter. And as you guys know by now, Bill Gross is very active on Twitter and communicating directly via that medium, which we love. And there's a few things he said this week. The first is, and they all come in this sort of yield, focusing on yield and carry. The first thing is, let's see, long-term transition. Total return investing morphs to yield carry, which morphs to principal protection. Timing will be key. So I'm really hearing him making more of a trading type of comment here rather than a long-term investing comment.
Yeah, I mean, basically he's saying start hiding gold under your mattress.
Okay. And really also, it seems like he's saying, for the past 20 years or however long it's been all about total return. Now it's going to be about, maybe things are going to stagnate for a little while, so you want to earn that yield, and then you can see things really start to sell off, so it's really going to be more about protecting the money that you have.
Right. I mean, I think it's about balancing risk and reward. Bonds used to provide a lot of reward through interest rates going down and bond prices going up. What he's basically saying is that point in time is behind us now, and that really what you need to focus on is getting the highest yield from the safest investments.
Gotcha.
And the last thing is then yield is not going to matter. It's just safety.
Gotcha.
And so the question is, when do you move from looking at yield to just what's not going to lose money?
Gotcha. Okay, so the next tweet is, which assets are the least bubbly? Quality stocks yielding 3%, long tips, Italian and Spanish bonds, gold, and some closed-end bond funds. So really, he is giving some direct recommendations about some things that you may want to be putting your money in here. Gold comes up again, and really we talked about this last week, Italian and Spanish bonds and front-running the Fed. But I think one of the things that we haven't seen up to this point is quality stocks yielding 3%. Your comments?
I'd love for him to give me a couple names. I'll be looking at what his stock funds, where they're investing, and seeing which ones are yielding 3%. Because here's the thing: if I can yield 3% on a stock, why would I want to hold a corporate bond that has no price appreciation possibility that's yielding 2.5%?
Gotcha. And then the last one, and this is just sort of a carry forward on what we were talking about earlier, is U.S. economy doing better, but 2.5% real growth seems to be the speed limit. Invest for safe yield carry, not asset appreciation. So just really more of a continuation of what we talked about earlier.
The only thing that you didn't mention is closed-end funds. And there's some weird stuff going on with Bill Gross. Have you heard about that he's buying his own closed-end funds?
Yeah, I've heard two things really. One is that one of the PIMCO closed-end funds is trading at a 40% premium, and the other is that he's buying two of his own closed-end funds, which are not the one that's trading at a 40% premium.
Yeah, but isn't he buying a fund that's still trading at a premium?
He is still buying a fund that's trading at a premium.
I think there's a story there.
There's definitely a story there, which you'll be seeing hopefully next week on Learn Bonds. Okay, great. So what else, as a transition there, what else are we going to be talking about next week on Learn Bonds as far as PIMCO goes?
Other things that PIMCO's buying. PIMCO's taking a bigger and bigger position in munis. At the same time, the muni bond market experts are saying munis look very, very expensive. But expensive is relative. Muni bond experts like to measure the value of munis compared to treasuries. Bill Gross is looking at munis compared to every other investment. So munis may be expensive compared to treasuries, but maybe everything's expensive right now.
Gotcha. Okay, anything else?
I think we're good.
Okay, great. That's the $200 billion worth of bond advice show for this week. We hope you'll tune in next week, and thanks for watching.